Hi, welcome to Super Macro Podcast. Johnny, hi.
Hi, Elvis.
Johnny, the markets are pricing in a recession, which seems to be the opposite of what you've been telling us in your morning notes.
That's right.
Have you changed your thoughts?
No, but I agree. The market is certainly challenging my conviction. It's beginning to get a bit lonely with this, but I still don't think we're heading into a recession. And I'm going to explain why.
Hi, welcome back to the Super Macro Podcast. My name is Elvis. Sitting opposite me is Jonny Matthews, the heart and soul of Super Macro. Hi, Johnny.
Hi, Elf.
Johnny, it's a difficult show today. Your thoughts and what you believe are going to be up for question. What's the first graph you want to share with us?
Yeah, I wanna just show what's priced into the market, certainly in the rates market. So this chart here shows the difference between the current Fed funds rate and what is priced into the interest rate futures in 15 months' time. Now, if you look at that, the market is currently pricing about 275 basis points of cuts over the next 15 months.
So that's recession.
That is really deep, horrible recession. I mean, even as the economy was heading into the abyss in 2007, 2008, the market wasn't pricing in a rate of or a pace of rate cuts at the current rate.
It's like the market hasn't got used to the fact we've got a different environment post the GFC.
Well, yeah, I mean, it's very, very different. Certainly, the private sector, the corporate sector are much less leveraged now than they were then. And I really don't think that the Fed is going to cut rates anywhere near as much as priced by the market. But, you know, this is what we're faced with right now. And what I would say is this, betting against this, you know, the odds are in your favor simply because even if you're wrong, there isn't that much more that the Fed is likely to go with the rate cuts. You know, the market has already priced in what I think is a deep recession and a very, very fast pace of rate cutting.
I see that, I think it was last week, beginning of last week, we saw that was it beginning of this week, but Citigroup were predicting 125 basis points of cuts in 2024 alone, which I thought was nearly fantasy land. But after the price action today, it seems to be moving closer towards that.
Yeah, I mean, the market certainly for the rest of this year is priced in over 100 basis points of rate cuts and then a further 100 basis points, a little more than a further 100 basis points for next year. So the market at the moment still is very much in the recession camp. And right now, the market is kind of priced almost as a coin toss for whether the Fed goes 25 or 50 to kick off this rate cutting cycle on Wednesday.
So tell me, look, you know, I've always been of the belief, which is something you've written about as well, if the Fed is too aggressive with rate cuts, the long end of the treasuries would sell off, you know, on the basis of the fact that you bring back some inflation. But everybody seems to think inflation's beaten. So is there any risk to the Fed cutting rates by what's priced in the market?
Well, certainly. I mean, if we go back through the history of the Fed, you know, if you go back 4 years at Jackson Hole, Powell was saying, came up with this idea of average inflation targeting. In other words, inflation was so low, you just couldn't get inflation back to the target.
Be careful what you wish for.
Yeah, they came up with this idea of average inflation target or price level targeting, where, you know, they would allow a period of overshoot to compensate for the period of undershoot. Then 2 years ago, the whole talk was of transitory.
Well, that was the overshoot, wasn't it? I suppose as well. They were allowed for that.
Yeah, that was it was all going to be transitory. And now, of course, we're in. You know, the Fed has decided, and other central banks, that inflation has been conquered. That's not the problem. The big problem right now is arresting the decline in the labour market. But sure, we've seen some cooling of the labour market from very, very overheated conditions. And I want to show you this next chart because I just don't see why the labour market should fall apart based on things as they are. This is a chart of year-on-year GDP growth in the red. And for the past 4 quarters, it's kind of been between, well, it has been between it's gone 3.1, 2.9, 3.1, 2.9. That's 4 quarters of growth.
This is real growth.
This is real
so
GDP
nominal
growth
is close to 6.
Well, yeah, certainly 5.5. Yeah. So real GDP growth of about 3%. Now, growth at that kind of pace should support employment growth. Companies are earning money. There should be demand for labour. Consumers are spending money.
You've talked about this. Earnings have been strong, and that should pertain to at least the same employment, if not more.
Yeah, and if you look historically at the kind of employment growth that you get while the economy is growing at 3%, it should be at least 1.5%. 1.5 to 2% employment growth. Now, what I've done on this chart is I've shifted the GDP growth rate forward a quarter so that the most recent growth rate lines up with closer to where we are in terms of year-over-year employment growth. We had the August labour market report, which was weak, but stronger than July. And people are very much freaked out over the deterioration, the slowdown in payroll growth.
Can we say also, you're showing us, as I can see, non-farm payroll growth, but non-farm payrolls are subject to revision the following month, subject to revision the second month, then an overall revision at the end of the year. So is this really a chart that is something that is telling us something, or is it something it will change as the revisions come in?
Well, sure. I mean, the whole of last year's total employment was revised down by 800,000. But assuming it's the same across, it's a kind of parallel shift downward in the monthly payroll prints. So there'll be 170,000 per month instead of 240,000 on average. That won't change the growth rate. It's not going to change the growth rate. It's just a downward shift in the level of total employment. The problem that you've got with all this economic data, it's always subject to revision. But this is what we've got to go on. And although there are certainly signs that the labour market is cooling, with GDP growth and consumer spending as strong as it is,
it's very hard to see the labour market deteriorating any further from here, or softening any further. Not deteriorating, that's a wrong word, softening.
Yeah, or falling into the abyss, the way the
that's why the rates market's priced. Okay.
But the other thing is if you look at consumer spending, I mean, the most recent consumer spending report that we had was for July. Now, this is real personal consumption expenditure, not nominal. And I've done this quite colourful chart to show you quarter by quarter the monthly total personal consumption expenditures on that's an annualized rate for that month in each of these bars. So the green bars, that's for the second quarter of this year. The blue bars are for the first quarter, and the horizontal line across them,
or the ascending horizontal, or extending horizontal.
Well, yeah, where it's horizontal, that is the average rate of consumption expenditure for the quarter.
Oh, I see.
So you can see the first quarter was a slight uplift on Q4 of last year, on average. Not that strong. Q2, consumption growth, I think, was at a pace of 3%.
Yeah.
And now we've got the July figure. And if you look at an annualized rate to the 3 months, in the 3 months to July,
looks like another jump, the same to Q2.
Well, yeah, on an annualized basis over those 3 months, it was growing at 4.8%. And let's put it this way, even if there's no further growth in August or September, if it just flatlines from here, growth in Q3, personal consumption expenditure growth in Q3 will be at a 3% annualized rate. And, you know, the Atlanta Fed GDP Now forecast, I think it has PCE growing at 2.5%. It's got GDP growth at over 2%. So the current quarter, we're still seeing pretty strong economic growth, or healthy economic growth. Let's put it that way.
You know, it's funny that you look at you give us these GDP numbers for the US, and then we can see the rates markets pricing in some sort of recession coming. But I think there's a lot of G7 countries would like to have the growth that the US has got is now.
Yeah, certainly. I mean, the UK is doing okay, has done very well in the first half of this year.
But Europe's nowhere near where the US is.
Europe, you know, we keep expecting a pickup, and it's been, you know, the growth on a quarter-on-quarter growth rate has been 0.3% for the first 2 quarters. The ECB downgraded its growth forecast for this year and next. Just small downgrades, but you know, they're looking at 0.8%.
It also feels like they're not quite as dovish as the Fed. It's like it's quite a strange phenomenon to me.
Yeah, I mean, Lagarde in the press conference yesterday, I think did her best to dial down expectations of another rate cut in October.
Yeah, the service inflation of 4.2, that's quite big, and that indicates they've got wage pressures over there.
Yeah,
which means that inflation will probably stay high.
Yeah, I think the hawks, you know, will make sure that they don't go too fast, and I think realistically, a quarter point every quarter is probably realistic.
And wait and see what happens, see how it affects things.
So going back to the US, though, Elvis, it's the same kind of issue where services inflation is keeping a high base to overall CPI inflation.
What are services as a percentage of the economy in the US, Johnny?
It's 70% of personal consumption expenditures is services.
So it's the elephant in the room.
Yeah, it really is. And so this next chart shows you the components of core CPI inflation.
That's the red bars.
Yeah, it's comprised mainly of services with an offset from core goods. Core goods, that's excluding energy and food, and core services are excluding energy-related services.
Right.
So most of core inflation is down to service inflation.
Which is wages, is that right?
Yeah, I mean, wages are a large part of it, but it's also, I think, you know, it's not just wages. It's a question of what you can get away with charging. I mean, if you think of these dynamic pricing structures that we have, these dynamic pricing models.
Airfares in particular.
Airfares, hotel prices, Oasis tickets, whatever it is. You know, there is a model that'll gouge as much as it can from the consumer. And the demand is there, so people are paying whatever it costs, and so, you know, we can see core CPI inflation was unchanged at 3.2% in the most recent print, and it's, you know, were it not for further declines in core goods prices, it would be higher, and I don't think goods prices are going to keep on declining year after year. I mean, they'll be giving the stuff away for free if they do.
But is China going to export some disinflation because they've got a problem with their economy at the moment and they see the way out as exporting?
Well, maybe if they can get away with it, yeah. But, you know, there's only so much more. There's only so much more import penetration they can achieve, really. But, you know, just looking at this, even if we take, I've put on that chart supercore inflation, which
the one that he considered to be very important until it got stay too high, then we don't talk about it anymore.
Yeah, so supercore excludes housing from this because housing or rent inflation has been, you know, very, very slow to decline.
Yes,
certainly the CPI measures. But even if you exclude housing, you're stuck with this supercore level of inflation, which is also not going down very much. And, you know, I suppose if you exclude all the stuff that's been hanging around for a long time, like, you know, vehicle insurance, housing and rent prices, all the stuff that is really, really super sticky, you're going to have an inflation rate that is where you want it. But
this is important what you're talking about inflation, because the Fed's dual mandate, they've considered this mandate and inflation done.
yeah,
They're done on this one. That's done. We've tamed that one. We don't have to worry about that. Now we've got to worry about employment. All we care now is about employment. But clearly, perhaps they haven't quite won this battle yet.
well, we don't know. I mean, nobody is an expert at forecasting inflation. Certainly not me. But as I see it, there is a risk that inflation is not dead and buried. And I've always said the Fed will start cutting once the labour market shows signs of weakness. And there is a risk that we will not get down to the 2% inflation target. In fact, I feel pretty convinced that we won't. And the Fed will start...
but that target is no longer a target, is it? Because they've accepted that it's going to be higher than that, and that's it, and we've won.
Well...
Yeah, is that that's how it seems to me? Perhaps that's what I'm reading.
I don't think they'd...
wouldn't openly admit it, but...
I think as far as the Fed's concerned and other central banks are concerned, if you have inflation in a 2 to 3% range, that's good enough. That's good enough. And certainly with the labour market showing signs of weakness, they want to normalise policy as quickly as possible. So, yeah, I mean, that's an outstanding risk. But as far as the markets are concerned, once the Fed starts cutting, they're going to make really, really, really deep cuts. And that is what's priced into the futures
The SOFR
markets.
futures, yeah.
SOFR futures, Fed funds futures, all of it, 2-year Treasury yields, everything.
Do you think that what the market's virtually pricing now, I think it's probably pricing over 40 out of 50 bit cut in September. Do you think if the Fed did cut by 50 basis points, it's maybe sending the wrong signal to the market? In terms of, are they worried or probably worse than create some more asset price inflation?
That's a good point. I'm not sure. There is a risk that if they go at the pace that's priced by markets, it's the equity
it's full
market.
on against
It's full on.
Yeah,
Equities will be
not
off
now down.
Off to the races.
Buy it, more buy. Yeah. Okay, fine.
Or there is the other risk that if they cut 50 bips to start this, that the market thinks, well, okay, they know something's wrong, and it creates an additional kind of source of panic.
So volatility again, whichever way you look at it,
whatever the outcome of this meeting is, there will be volatility in equities and in the rates market.
Rates market, yeah, the rates markets. The volatility has been even more than equities recently.
Yeah, but the one thing that I would say is that since the start of the rate hiking cycle, and I will be writing about this in the weekend note. Since it started, most FOMC meetings, Powell manages to get the 2-year yield right down. Yeah, it's quite incredible.
It's like he's got a bet on it.
Yeah,
I didn't say that.
He is incredibly dovish. I don't know whether he can manage it this time. I mean, why would he want to?
He'd have to be extraordinarily dovish to manage it this time, to get it down, get the yield down further from where it is already trading.
Yeah. Let's just look at these SOFR futures in this next chart. So this is as of the 12th of September.
That's a dramatic move, isn't it?
From the end of July to now, this is basically these SOFR futures represent the market's idea of a 3-month rate at different points in the future. So you can see that the current 3-month SOFR rate is something like 5 and a bit percent. I mean, the Fed funds target rate is 5.25 to
5 3/8 mid. Yeah.
But a 3-month rate is closer to 5, and the market expects the 3-month rate by December of 2025 will be down at about 2.75%, and you can see that on the chart. And will continue to decline a little bit further into the middle of 2026 and then start rising again. But the low is close to 2.75%. And that's basically saying the Fed, within the next 18 months or so, is going to take the Fed funds target rate, the SOFR 3-month rate, down to what it considers its neutral rate in a very, very short space of time.
Right.
The market is saying the Fed just wants to get to neutral almost immediately.
But this neutral rate's up for discussion, isn't it?
Nobody knows. But they're the first to admit they don't know what the neutral rate is. But it's their idea of a rate that is neither providing stimulus or holding the economy back.
I'll tell you what it will do: provide asset price stimulus.
Oh, for sure.
Without a shadow of a doubt. Sure they must know that.
We had just yesterday, we had the latest Fed release of household wealth.
Yeah.
And that was, of course, at another record high. And I think as soon as the Fed gets going with the rate cuts, you're going to see housing values take another leg higher and equity markets rally.
So it just feels as though that this rate cutting cycle, if they do it as anywhere near what the market's pricing, is going to blow the balloon even further, get the balloon even bigger.
Yeah,
for
I
a
think
bust
so.
at some stage.
I mean, the wealth to income ratio, I think it peaked below 7 just prior to the internet bursting. I mean, it's now close to 8.
Wow.
And that's just saying, well, okay, on average, the average household wealth is close to 8 times the average income.
Wow.
So nobody has to work anymore.
Yeah. And everybody's got a lot of money to spend if they start realising some of that wealth.
Yeah. I've got one other chart.
I like this chart. I like this chart.
This is, some of the craziness priced into the rates market. In fact, before I show this chart, I want to let's just go and look at where rates are.
Yeah, yes, I was going to suggest that.
Okay. So what we're looking at here is the current 5-year Treasury yield is 3.43%. The current 5-year TIPS yield is 1.47%.
Indicating?
And what that means is the market is basically saying you've got a choice. You can either buy a 5-year regular Treasury that will pay you 3.43, or you can buy a 5-year TIPS, which will give you inflation plus 1.47%.
So you back out inflation as...
So really, the difference between the two is less than 2%. So the market is saying, if you choose a regular 5-year Treasury, you are effectively saying, I think inflation will average lower than 2% over the next 5 years.
Currently, headline inflation is 2.5%. That's going to need a substantially lower numbers to come in to reach that average of, below 2%.
Yeah, I think, and not only that, the 2.5% reading on CPI inflation was helped by this continual decline in goods prices that we've had over the last year and lower energy prices. Now, excuse me, that won't carry on forever. Energy prices will stabilise and then there'll be no change in year on year.
So short the nominal, long tips.
So, without getting complicated, you've got a choice. You can either buy the tips paying you 1.47%.
Plus inflation.
If you think inflation is going to be higher than 2% over the next 5 years, and you'll do a lot better than buying a 5-year nominal Treasury at 3.43.
Okay, Jonny, thank you very much indeed for running us through the slide deck. I think that most of the people listening will know what you think. Can you tell us what you've got on, or you want to keep that for the super macro readers?
Yeah, I think that really should be for the super macro readers. You can subscribe to my note. It's at that super-macro.com. It's on the screen. I give a daily summary of the important economic data each day, and then on the weekend there's a more detailed note that summarizes the week's economics and the implications for markets. I go through everything that's going on in the markets, everything important, and I talk about my own portfolio.
And you're offering like a 1-month free trial, which costs, very little. I think 30 cents for the 1-month free trial.
Well, yeah, there's no, we just recover the credit card costs. So certainly you can get it on a free trial for a month, and then hopefully you'll like it and you'll take up a subscription.
And to be very clear with everybody, that everything that Jonny's talked about today, his thoughts are his thoughts and opinions. That it's not investment advice.
No, certainly. Look, this is just me. I could very well be wrong, but I think I've structured the trade so that if I am wrong, the losses are not going to be catastrophic. And year to date, even though I've had a rough couple of weeks, still up about 16% for the year to date. And the track record over the past 4 years is excellent, if I say so myself.
Thank you so much.
Right. Thank you, Elvis.